I have a serious question for you. Is the next 10 minutes of your time worth $1 million? Because for some of you, this video may change your way of investing. If you only invest in the ETF QQQ, then your return in 2022 was down negative 32%. But if you had only chosen to invest in the Magnificent 7 stocks, then you would have been down negative 56%. And if your investment going into 2022 was $100,000, then that security blanket from QQQ would have saved you $24,000 over investing it into the individual stocks of the Magnificent 7. And that's exactly why so many investors prefer to invest in exchange-traded funds, because they give you the diversity and they also help to minimize your losses. But is that the whole story? Is investing into exchange-traded funds the best option for every investor? And of course, my answer is no, absolutely not. And I'm going to explain why. As a reminder, the Exchange-Traded Fund, or ETF, of QQQ has the top 100 companies from the NASDAQ, and that happens to include the Magnificent 7, which happens to be, as most of you know, Microsoft, Apple, Nvidia, Amazon, Alphabet, Meta, and of course Tesla. So why would a person choose to invest in the Magnificent 7 independently if they're already in QQQ? So in this video, I'm going to give some high-level details about QQQ, and then I'll dive into the Magnificent 7 stocks and their performance over time. And of course, I'll provide some pros and cons about both styles of investing. And for some specific groups of you, there's an extra $1 million on the line. And it all comes down to understanding how ETF versus stocks compare during the good times, but also in the bad times. And the reason why I chose this topic is because I recently covered the future forecast for the Magnificent 7 stocks, where I cover which ones are the most undervalued. And of course, one of the comments put in the most simple of terms: why not just invest in QQQ? And in a recent poll that I put on YouTube, 40% of you also agree that QQQ is the right way to go. And there's 60% of you that are taking the more manual approach. So the question is, which group is on the right path? Let's go ahead and unpack this. But before I do, if you get any value from my videos, please consider pressing the like button so my channel can continue to grow. And hopefully this video is worth an extra $1 million to a few of you. Let's start by discussing the ETF of QQQ, which has over 100 assets in its holding. And you can see that the Magnificent 7 make up 39% of the fund's holdings, despite being only 7 of those 100 companies in the fund. And QQQ is the 5th largest ETF in the United States based on assets under management. So it is clearly very popular. And a major pro for this fund is that it always has the top 100 companies from the NASDAQ, where it rebalances the weights of those companies, or the amount that it has invested into each of those companies, every quarter. And once a year, they decide to either add or remove companies based on the NASDAQ 100. So not only does this fund have the Magnificent 7, but it has 93 or more top companies from the NASDAQ, helping to drive the return even higher, all while giving it a little extra diversity when there happens to be a pullback in the market. And of course, then we have the cons for QQQ, where of course you're going to have an expense ratio of 0.2% for that rebalancing of the fund. And with having 100 companies, that diversity can also hold back the total return if only a handful of the companies show growth. Granted, if they all have explosive growth in a particular year, then of course that fund is going to be unstoppable. Now, taking a step back, when I talk to my friends and my family, I highly encourage them to have QQQ in their portfolio because it's an incredible fund, where if you look at the growth for the past 5 years, it has been well over 100%. And if you happen to be a new investor, then this fund is a no-brainer. I mean, this fund is going to serve you well no matter where you're at in your investment journey. Along the lines of stocks seeking to break out from the crowd, let's talk about today's sponsor, Digital Asset Technologies Incorporated, which has strategically pivoted from alt-food to digital asset infrastructure and blockchain technology. The company acquired Liquid Link AI Corp, which is developing XRPFY, which aims to be the Google search engine of Web3, providing tools for intelligent search, discovery, and powerful routing for building and scaling in the Web3 economy. It facilitates fast, cost-effective payments across blockchain networks and traditional finance, finding optimal currency conversion routes. Here's just a handful of reasons why digital asset tech is prepared for growth. The tokenized asset market is projected to explode past $16 trillion by 2030. It also offers unique exposure to blockchain infrastructure via a public vehicle backed by proprietary XRPFY. DAT happens to be the first public company that's actively building on the XRP ledger, and investors can participate at ground floor prices from the recent stock restructuring, with the company trading below 15 cents, and it has a small market cap of approximately 7.4 million. And they're also backed by proprietary technology to create a moat with their expanding use cases. If you're interested in learning more about digital asset technologies, please check out the link down in the description. So why would a person want to take on the risk of only investing in 7 stocks instead of all of QQQ? Sure, Nvidia has had a great couple of years, but Amazon has been flat the past year and only up 56% over the past 5 years. That kind of return is way lower than the 114% from QQQ over the same time frame. So, do you see where this is going? And another major downside from investing in a handful of stocks like the Magnificent Seven is that when there's a bad year, it is extremely bad for them. I mean, just refer to the example at the beginning of the video, where in 2022, QQQ was only down negative 32%, but the Magnificent Seven were down negative 56%. And if you look at the worst year performance, you can see that Tesla, Meta, and Nvidia had pulled back an insane amount of all over a negative 50%. Every investor needs to level set that the good years for individual stocks are absolutely great. But of course, the bad years can absolutely destroy your portfolio. Now for that $1 million question. Which one is best? Rather, which one has performed the best historically? And of course, this is where I give the disclaimer that all past results are not guaranteed for the future. But when I ran a backtest against the Magnificent Seven and QQQ over the past 15 years, where only $10,000 was invested, one portfolio was worth nearly $1.1 million today, and the other is worth almost $100,000. And the winner happened to be the Magnificent Seven, coming in with a compounding annual growth rate of over 43% every year, with its best year over 229%. Can we all just take a second and recognize that if you'd invested $10,000 into the Magnificent Seven 15 years ago, those investors would have over $1 million today? I don't know about you, but in 2010, I was only 5 years out of college and I only invested in ETFs. It wasn't until around 2014 that I actually expanded my investments into individual stocks. And honestly, that is when my portfolio began to blow up. Now, I do have to push pause here for a second because there are 2 minor glitches with the results that I had shared. And I know this will come up in the comments, so I just want to address them right away. The first is going to be that there will be many people pointing out that there is an ETF for the Magnificent Seven. So why shouldn't you just buy that instead? This is called the MAGS ETF, and it has a few issues that most of you are not aware of. The first being the 0.29% fee compared to the Magnificent Seven, which has no fee. Just so you know, that would cost a person with $100,000 invested with $10,000 added each year a difference of over $220,000. That's how much 0.29% would cost you over 30 years. But once again, that's assuming that you have the same return. The MAGS ETF isn't exactly what you think it is. If you dig a little deeper, it has over 58% of the fund made up of US Treasuries and cash. And of course, when I run another backtest for the past 2 years, and keep in mind I can only go back 2 years since the MAGS ETF is relatively new, then we can see that MAGS did better than QQQ, but it was still way behind the actual Magnificent Seven. And despite me showing this, I know there's going to be people in the comments pointing out the MAGS ETF because they probably skipped this part. Now, I had mentioned that there's 2 different flaws that people are going to point out, where the first was that there's a Magnificent Seven ETF. And the second is that these companies had some of their strongest growth over those past 15 years. Chances are they aren't going to see that level of growth ever again. But as a foundation, the MAGS 7 is a great way for those of you that are wanting to expand beyond just investing in ETFs. And I agree that most of the Magnificent 7 will never see that same level of growth again. But that's the whole point of my channel, trying to seek out the best undervalued stocks, like when I covered Palantir in June of 2023, up 893% since then. Or CrowdStrike in that same video, up over 221% since then. And of course, there's Nvidia at the same time, now up 246%. Or my other videos in 2023 where I first began speaking to all of these other companies. And this is how much they are all up today. My point in sharing this is that we need to keep educating ourselves and looking for that next opportunity to hopefully turn that $10,000 into $1 million in 15 years. And like I said, that's the whole point of my channel, to keep honing in on opportunities to help provide educational information for all of you to go out and do your own research to find out what makes the most sense for you. For me, making the shift into investing into individual stocks is really what helped me to retire nearly 20 years early. But I have to point out, I was very smart about it, and I did a lot of research, and I've always been in it for the long game. I hope that this video was able to open some of your eyes to the opportunity of investing beyond just ETFs. As always, thank you so much for watching.